Welcome. Today we're diving into IAS 2, the international accounting standard that governs how companies account for inventories. Inventories are a crucial part of many businesses, and understanding how to value them correctly is essential for accurate financial reporting. IAS 2 covers everything from the initial recognition of inventory to how it should be measured and reported in financial statements. In this video, we'll focus on two important aspects: write-downs to net realizable value (NRV) and the reversal of those write-downs. Let's start by understanding what NRV means and why it matters. Realizable value, or NRV, is a key concept in IAS 2. It represents the estimated selling price of inventory in the ordinary course of business, minus the estimated costs of completion and the costs necessary to make the sale. In other words, NRV is what a company expects to receive from selling its inventory after accounting for all related expenses. This value is important because it ensures that inventory is not overstated on the balance sheet. If the NRV falls below the cost of inventory, a write-down is required. Let's see how this process works in practice. Write-down to NRV is necessary when the cost of inventory exceeds its net realizable value. This situation can arise due to damage, obsolescence, declining selling prices, or increased costs to complete or sell the inventory. IAS 2 requires companies to assess their inventories at each reporting period and compare the cost to NRV. If NRV is lower, the difference must be recognized as an expense in the period. This ensures that the financial statements reflect the true economic value of the inventory held by the business. Calculate a write-down, subtract the NRV from the inventory's original cost. The resulting amount is the loss that must be recognized in the income statement. For example, if inventory was purchased for $10,000 but its NRV is now $8,000, a write-down of $2,000 is required. This adjustment is essential for presenting an accurate picture of a company's assets and profitability. The write-down amount is recorded as an expense, reducing both the value of inventory on the balance sheet and the company's net income for the period. A write-down occurs, the accounting entry involves debiting an expense account, typically called inventory write-down or loss on inventory, and crediting the inventory account. This reduces the carrying amount of inventory on the balance sheet and recognizes the loss in the income statement. For instance, if the write-down is $2,000, you would debit the expense and credit inventory by that amount. This process ensures transparency and compliance with IAS 2 requirement. Write-down to NRV affects both the balance sheet and the income statement. On the balance sheet, inventory is shown at its lower NRV, ensuring assets are not overstated. On the income statement, the write-down appears as an expense, reducing net profit for the period. This adjustment provides a more realistic view of the company's financial position and performance, which is crucial for investors, creditors, and other stakeholders relying on these reports. IAS 2 also addresses situations where the reasons for a previous write-down no longer exist. For example, if the selling price of inventory recovers or costs decrease, the NRV may rise above the previously written-down value. In such cases, the write-down can be reversed, but only up to the amount of the original write-down. This ensures that inventory is not carried at more than its original cost. Let's look at how this reversal process works in practice. Reversal of a write-down is only permitted if there is clear evidence that the NRV of inventory has increased. This might happen due to market recovery, improved product demand, or reduced costs. The reversal is limited to the amount of the original write-down, ensuring that inventory is not overstated. The increase in value is recognized as a reduction of expense in the period when the reversal occurs, improving the company's net income for that period. Reviewing a previous write-down, the accounting entry is the opposite of the original write-down. You debit the inventory account and credit the expense account. This increases the carrying amount of inventory on the balance sheet and reduces expenses in the income statement. However, remember that the reversal cannot exceed the amount of the original write-down. This ensures compliance with IAS 2 and maintains the integrity of financial reporting. IAS 2 requires companies to disclose the amount of any write-downs or reversals in their financial statements. This includes the circumstances that led to the write-down or reversal and the impact on profit or loss. Transparent disclosure helps users of financial statements understand the nature and significance of inventory adjustments, supporting better decision-making by investors and other stakeholders. Let's consider a practical example. Suppose a company holds inventory with a cost of $50,000. Due to a sudden drop in market prices, the NRV falls to $40,000. According to IAS 2, the company must write down the inventory by $10,000, recognizing this amount as an expense. This adjustment ensures that the financial statements reflect the true value of the inventory, protecting users from being misled by outdated or inflated figures. Now imagine that in the next period, market conditions improve and the NRV of the same inventory rises to $45,000. The company can reverse $5,000 of the previous write-down, but not more than the original $10,000. This reversal is recognized as a reduction of expense, increasing net income for the period. The inventory is now carried at $45,000, reflecting its improved value while still complying with IAS 2's requirement. Regular review of inventory values is essential for accurate financial reporting. Market conditions, costs, and demand can change rapidly, affecting the NRV of inventory. By consistently applying IAS 2's principles, companies ensure that their financial statements remain relevant and reliable. This practice not only supports compliance but also builds trust with investors and other stakeholders. Applying IAS 2 can present challenges, such as estimating NRV accurately, identifying obsolete inventory, and documenting the reasons for write-downs or reversals. Companies must use sound judgment and maintain thorough records to support their decisions. Regular training and clear internal policies can help ensure consistent application of the standard across the organization. Wrap up: IAS 2 ensures that inventories are valued at the lower of cost and net realizable value. Write-downs protect against overstated assets, while reversals allow for recovery when conditions improve. Accurate application of these rules leads to transparent and reliable financial statements. By understanding and following IAS 2, companies can provide stakeholders with a true and fair view of their inventory position. Thanks for watching and stay tuned for more insights on accounting standards.